Okay, so we got a chapter 5 request. Bless you.
Thank you.
E5B 31. We'll take a look at that one to start. And then if we got more questions, we can dig in deeper, okay? So we're like chapter 5, 6, 6, 7. Is that it? Let's take a quick look. Yeah, we're like 5, 6, 7. Right in there, okay? So I got this problem, and it says, journalize the following transactions for Moody bicycles using the periodic inventory system. So what you got to realize, there's 2 different ways to account for this stuff in chapter 5. And if you look, I believe in the back of your chapter and possibly in that chapter's appendix, they show examples of journal entries using both the periodic and the perpetual system. Most of the problems will require the perpetual system, but this particular one asks you to use the periodic system, which has more accounts involved. Okay? Yeah, the weather's not that great. So just remember, periodic has more accounts involved. The other thing I want to make a point about is, in the periodic, you'll notice that you don't ever touch cost of goods sold or inventory in your journal entries. In the perpetual system, because you're able to make entries to cost of goods sold and to inventory, you don't need all of these other accounts. Okay. So we'll go through this, and then maybe you can review that when you're doing the reading, those points I made about the 2 different systems. Okay. So it says we purchased 3,200 of merchandise inventory on account, and the terms are 2/10 N /EOM and FOB shipping point. So there's a lot involved in that. This is a great chance to go over that. Does anyone know what 2/10 means? Okay, so this is the way it's stated on the invoice. It's just standard business lingo here. And this means the first number on the left side of that slash is the discount percentage. Okay? So it's what it's saying is you're allowed a 2% discount if you pay this bill within 10 days. So the number after the slash is the number of days that this bill has to be paid in order to get the 2% discount. Okay, so it could be jockeyed up with any number in there. You know, it could be like 3/15, 1/30. It's probably more common to have a shorter payment period, less than 30 days, because what are we trying to do? Think like a business person now. We're trying to, why would we do this if we were sending someone a bill? We're trying to get the money in quicker. Right? We're trying to get our cash flow, so we're willing to give up 2% to get that money quicker. Kind of like when a business, like a pizza place, they'll accept a credit card, and they'll get that money in their account the very next day. But the thing about that is when you accept a credit card as a business, you got to pay, the business has to pay the credit card company a percentage, and it's usually between 2 and, I'd say American Express gets closer to 4%. So the company's willing to give up.
So do we have to pay each credit card company?
Yes.
So we have Visa,
Yeah. And it's usually set up where your bank account, it just gets drawn out of your bank account. So at the end of the day, you probably batch all of the transactions on the credit card machine, and what that does is it lets the credit card company know what your total credit card sales were, and then they suck it right out of your account.
Yeah, you have to do that as a server. You have to log all your credit card transactions.
Yeah. So this is a real world thing, but this is the same concept as a credit card. It's just that we're extending terms to our customers directly. There's no credit card in the middle of this. It's just we're taking on the full credit risk. See, the other neat thing about a credit card is the company that's accepting the credit card gets to basically pass the risk of collection on to Visa or MasterCard, and they get that money in return. So what we're doing here is we're telling the customer, okay, if you pay in 10 days, or actually we're buying it, okay? So the company we're buying from is saying, okay, if you pay in 10 days, you can get a 2% discount. Otherwise, that N there means the total. You see the next set of terms? So that's basically saying the total is due, and who can guess what EOM means? End of the month, right? So you either pay in 10 days to get the 2% discount, or you pay all of it by the end of the month, okay? And then an additional thing that could be attached is a finance charge. So that might not be listed in the bill, or there might be a note in there saying that if you don't pay by the end of the month, then we're going to charge you, 3% per month or whatever it is, right? There's usury laws which don't allow you to charge. It caps it, right? The law doesn't allow exorbitant finance charges. Okay, so you might want to look that up. Usury laws. Okay. Now, what does FOB shipping point mean? First of all, what does FOB mean? Does anyone know what FOB means? Usually we get more people laughing, right? FOB, but it means free on board. Okay, so that's really indicating when the title of these goods transfer. So it says free on board shipping point. That means that this company that's buying is taking possession of the goods at the shipping point. Okay, it could say FOB destination, and that means that the transfer of goods doesn't happen until it gets to the destination. So it's really how we identify when and who has title to the goods, meaning when and at what point in time or what place, location, and who has the title, who owns the goods. Okay, so FOB shipping point, whoever's buying it is now the owner of the goods, and of course that means that the buyer would have to pay for the shipping cost versus FOB destination. Then the seller would pay for the shipping cost. Does that make sense?
Is that like the same thing when you have to pay for shipping?
Yeah, like if you order something and you have to pay for the shipping, then that's pretty much FOB shipping point.
Oh, okay.
Yeah. Okay. So what we're gonna do is we're gonna record the purchase. So we're in the periodic system, so we're not gonna book it directly to inventory. If this was the perpetual system, then we could book it directly to merchandise inventory. But we got to keep everything separate here. So we're gonna put it into what we call a purchases account. And during the accounting period, this account will accumulate all of the stuff that we bought during that accounting period. So we're gonna book it. And then we would close that account too at the end of the accounting period. So this is a temporary account which shows everything that we bought during the accounting period. Okay. Now, if it had been a problem with the perpetual system, we would just stick it right into inventory. Okay. And it sounds like we did it on account, otherwise we wouldn't have these terms, right? Can you see that? I mean, some of this, it kind of has to click, like, okay, this must mean that we bought it on account. So we got an accounts payable. We owe money. Otherwise, we wouldn't have this whole thing about the discount and all of this being due at the end of the month. Had we paid cash, we would have just credited cash, and the deal would have been done. You see what I'm doing? Okay. Does that make sense? So, two things increased. Our purchases increased, and the amount that we owe increased. Okay. Or for Moody, wait, let's see. Yeah, Moody Bicycles. Okay, now we returned 850 of defective merchandise purchased on November 2nd. So this is an instance where we're returning items, and we have to put in what we call a purchase returns and allowances account. It's not a sales returns and allowance account, it's a purchase returns and allowance account. Okay, so it says $850 worth, right? So we will reduce accounts payable. We no longer owe $850 out of the original $3,200. And then we're going to stick this into a purchase returns and allowances account. Okay, so had this been, and I'm going to keep talking about the perpetual system as we go along, so you can compare and contrast. Had this been the perpetual system, we would have just reduced the inventory account, right? Maybe I should make a little thing here. And we can kind of just, so, right? Had this last transaction, it still would have been, I'm going to just abbreviate accounts payable, but we would have reduced inventory. Okay, so that's the way it would have looked in the perpetual system. Maybe we do this. Okay. And then the first one would have looked like this. Okay, maybe visual so you can see, because I'm just talking about it, but that's the way it would be different, okay? And we can keep popping this thing up. I'll just jot down what perpetual would have looked like. Okay, we got a good job on that one. Now let's see. We paid the freight bill of $140 on the November 2nd purchase. Okay, so remember, the cost of an asset is everything that goes into getting it to its intended use. So as far as inventory goes, if we have to pay shipping on the inventory, that inventory is going to become, that shipping cost is going to become part of the cost of the inventory, which actually ends up in cost of goods sold when we sell that inventory. Okay, so remember, we cannot book it directly to inventory in the periodic system, so we need an account to keep track of that freight cost. We're going to book this to what we call freight in. Okay, so the cost of bringing the items into our business is called freight in. So I'm going to put $140 in there.
So is that an asset
Um,
or is
In a way, it is an asset, but it's actually going to end up being an expense because it's going to end up getting expensed out through cost of goods sold when we actually sell this item, right?
okay.
But it does sit as part of the inventory cost before we sell it. Okay. It's just that we cannot stick it right into inventory. Now, before we press enter on that, I'll just move this guy up. I'll show you how that would have looked in the perpetual system. So remember, over here in my spreadsheet, that's perpetual. We would have booked it directly to inventory. Okay. And notice the word paid is in there. So that should trigger in your mind. By now, having done a lot of these problems, paid means that cash was spent. So that's why I'm crediting cash. Okay, so see the difference now, right? Notice in perpetual, we don't have as many accounts involved because we can use the inventory account readily. Okay, we don't have to wait. In the periodic system, we'll end up determining what the inventory balance is at the end of the period. That's why the word periodic is in there, because we periodically come up with the inventory balance and come up with cost of goods sold. Okay, so it's done on a periodic basis versus the perpetual system where you can perpetually know your cost of goods sold and inventory balance. It's a running total because look, we're booking to those accounts. Okay, great. Now we're going to sell some of this. So now we're on the other side of the whole thing, right? Up to this point, we've been buying, right? Now we're selling, right? So in business, everybody's either buying or selling, but you know, everybody is buying and selling.
So when you buy it, does it accounts payable?
If you buy it on credit, if you don't pay for it right away, it's accounts payable. So say you're running a pizza shop and you got to buy the cheese and the, I don't know if you buy it from the same, I'm sure there's different vendors that you buy the vegetables and the cheese from, but say it's the cheese. When I think of pizza, I think of a lot of cheese and dough involved, right? So you're buying it and you don't pay for it right away. You would end up getting a bill, and that probably would be in the real world what would trigger you to book the accounts payable, the purchase and the accounts payable is when you get that invoice. Okay, yeah. So now we're going to sell it, right? So we're selling merchandise inventory on account. Now, since this company is selling it on account, they don't get paid right away. They have what they call an accounts receivable. So they're on the other side of the transaction now. They're Moody Bicycles is now waiting to get paid for something they sold, okay? So we got accounts receivable, and then we have what we call sales revenue. So you know, in textbooks, a lot of times, when merchandise is involved, the indicator is the word sales. Think about previous chapters, they said service revenue, okay? It's nice that in this chapter they say the whole thing, sales revenue. But in some problems maybe, or in some other textbooks, they might not put that word revenue on there. And it's up to you to realize that that's revenue. Okay. The word sales means revenue. Okay. They're going further in this situation and they're saying sales revenue, which I like, it's nice. But it's perfectly okay for them to title the account sales, and it's you that need to realize that it's revenue. And that word sales kind of indicates that this business is selling something tangible versus a service. Okay? And that's the same for the service chapters. They could just say revenue. They don't have to say service revenue. Okay? So it's really not the title of the account, it's what that account is doing. And this account is keeping track of our revenue from selling the merchandise. Okay, so it says we sold this merchandise inventory on account 6,700, and we extended, Moody Bicycle extended terms 1% if paid in 15 days. Otherwise all of it, so the N means, you know, we always said the N meant net, but when you think of net, you think of a gross number minus the discount. So I'm just going to say that N means total. So all of it is due in 45 days. Okay. And like I said, to further incentivize the payment in a timely manner, right? Not necessarily within the discount time frame, but within the 45 days, you actually could attach a finance charge. I'm sure you've seen it on bills that you've gotten, right? If you're late paying, then there's that negative incentive that you're going to get charged interest if you don't pay. So there's two incentives going on. There's the positive incentive of getting that 1% off if paid within 15 days. And then you could also have that other incentive. Okay, you're going to get penalized with a finance charge if you pay beyond 45 days. So that's different ways that we can kind of prod the customer along. Oh, what did I forget something? One or more of the amounts that you have entered are incorrect. Please refer to the information given to you in the question and carefully check any calculations needed to record this transaction. Make sure the debits equal the credits and try again. Okay, do you guys read your full error message when you have an error? Or do you like, okay, it's like, I'll just click it away real quick and try again? No, I just wondering. Right? So I'm glad I read it. What did I do wrong? Sold merchandise inventory on account for 6,700. Payment terms were 1 and 15 other way on.
Maybe it was,
That sure looks right.
yeah, it does. Maybe they were asking for purchase instead of sale. I don't know why, but. Yeah.
Shouldn't be, otherwise it's kind of a botched problem. Let's see. No, because they have 15 days from November 10th to get the discount. What does it say up? Journaler. Oh, yes. Assume the company uses the net amount to record sales. So it's assuming that they get the discount up front. Is that what they're saying? That doesn't sound. go ahead and click that. What do they want? Okay, so they're using the net method. They're putting the discount in off the top, which is okay. Let's see. How did you get the discount here? I'll show you how you got the discount. Okay, so what is 1%? You go 6,700, right? Now what is 1%? If you thought of 6,700 as 100%, okay, what's that less 1%, right? So if I diagrammed it here.
Wait, why is 150 1%?
Well, watch. 67, right? And if you treat that as 100%, okay, and you got a discount, right, of 1%, wait, 1%, then what do you have when you subtract 1% from 100%? You got 99%. Right? So what we're going to book is we're going to book the net amount. So if you took 99% times 6,700, you get 6,633, which is the same as going the long way. You could say 6,700 times 1% equals, right? And you could take 6,700 times 1%, that's 67, and then you could go 6,700 minus the discount, and you get the same number. But what you could just do is say, okay, it's a 1% discount, so whatever is left over after we take out 1% is the amount that we're going to book, right? So that would be 99% that's left over. Right?
Where'd you get 1%?
It's right here.
But it's basically saying, it's not 1 out of 15, it's between those 15 days.
Yeah.
Yeah.
Yeah. Remember how I explained it up here at the top? When I explained 2 and 10? Same thing, right? So the terminology, right? The format is if you pay within 15 days, you get 1%. 1 in 15, otherwise n, the total, is due in 45. So that doesn't change.
Okay, so if it's 2, it's 2% in 15 days.
Yeah,
Right.
right. So let's diagram it so everybody understands. So 1/15 and what did they have? 45. So the way you read that is okay, the 1 there, that's the discount percentage. And oops. That's the time frame to pay within in order to get the discount. Okay. And this one's in days. So that's the number of days from when this sale or this purchase is made. Okay. All n means is the total. So we'll diagram it out. So the n is the total. Okay. And the number after that, right there, the 45, is number or time frame, right? Number of days in which the total amount, right, is due. Okay. Does that make sense? So now they threw this thing about the net method at us, which I wouldn't expect in a exercise. So normally we would record it at the gross method, using the gross method, and then take the discount later when it actually happens. But what they've done is they've set it up where we record it as if the discount had already been taken. So just like we did over here. Oops.
Can you do the formula?
Yeah, there's the formula. Okay. So we were given 1/15 N45. Okay. I'll put that here. So that means if we pay within 15 days, we get 1%. So we recorded it assuming we are going to pay within 15 days. So we went ahead and took the discount, 67, right, which is 1%. So this is one way to do it, right? You can first compute discount, right, which comes out to, oops, the whole thing went all the way right, which comes out to 1% of the gross amount, $6,700, which is $67. And then the second step would be to minus the discount from the gross amount. Okay? And the gross amount is 6,700. Okay. So this would be the net amount, net of discount. You see what I did? Okay. So that's one way to do it, which is fine if you want to take several steps. The other way is to think in your head, okay? 1%, right? If there's 1% that we're going to get taken off of this, what will we be left with? We would be left with 99%. Right? You can do that in your head, right? If you're not going to have to pay 1% of something, you have to pay 99%. So you could just take 99% and multiply it by the gross amount. So in this instance, in my head I said 100% minus 1% gives me 99%. And I went ahead and multiplied 99%, maybe not in my head, but I multiplied 99% times the gross amount. The same gross amount that I did over there in yellow. And it gave me 6633, which is the same as what we did going the long route. And both ways work. So whichever you're more comfortable with, but that's the same net of discount. Okay? Does that make sense? So now we kind of got stumped because we had to do it the net way and we got it wrong and we went ahead and clicked through. Okay. Now it says paid the amount due. Wait, pay the amount owed on credit purchase from November 2nd.
Less the discount.
Less the discount. So this one is not done in the net method. The purchase wasn't. Okay, so let's see. They go ahead and tell you less the discount. And some of the bigger problems, you have to go back and count the days. In this case, we don't have to count the days because they're telling us that we did it within the time frame. But we're going to count the days just to make sure. Okay. So I'm going to go back and look at the original terms. It said 2 and 10. So November 2nd, and now we're on November 11th. So it sure looks like we're still within 10 days because we're not on the 12th yet, right? We did that thing on the 11th, okay? On the 2nd, right? So we're gonna pay it less the discount, and this is gonna be a purchase discount, okay? So we're gonna be paying off accounts payable. The whole accounts payable is going to go away. So you got to scroll back up and say, okay, we owed 3,200. That increased when we credited that account. Now we're going to pay that off. So we got a debit accounts payable. Accounts payable is going to go down now that we debited.
Didn't we take out over return?
Yeah, good. I almost missed that too. So yeah. What you need to do is you need to figure it out. So it might help if you keep a... I'm sorry, what was your name again?
Mateo.
Mateo. Excellent. Okay. That's one good reason to keep a T account going. And there's a little more involved in this exercise. Okay, so had I kept a T account, some people say, oh, T account, silly thing, but the little silly thing helps you keep things straight. Right? So originally we had 3,200. This was from November 2nd. Okay. Now look, like Mateo said, on the 6th we returned some. Okay, we almost missed that. 850 reduced the accounts payable if I had posted that to the T account on November 6th. So currently, if you were to run a balance on this, right, the way you find your balance is get the difference between the credits, the debits and the credits. Now in this case, the credits are more than the debits, so we got a balance of 2,350. That's what we're paying off. All right. So I'm going to take that number, 2,350, and that's what I'm going to reduce my accounts payable by. There. Right? And this, you know where I got the entries in the T account from, right? Okay.
So you just
Well, I'm not even to the discount yet. I'm just getting to the balance that we're paying off. Yeah, so see, if you trace back November 2nd, when we originally purchased these items, we owed 3,200. Then for some reason we returned some. So when we returned some, that made our accounts payable go down by 850. See that debit to accounts payable in the journal entry? So it would have been, it is great that we keep a T account. You might want to keep a T account when you're doing your homework, pencil and paper, so you know what balances are in there, and we don't get caught, right? We got caught. I don't know if it's too early in the morning, it's noon. So usually something like that wouldn't happen, might happen early in the morning when you get there, or it might happen after you eat in your lunch. Well, I don't know what it is now. Maybe we didn't have enough to eat, right? Okay, so we made a mistake. Mateo caught it. 850. So we come up with a new balance of 2,350. That's what we're going to be paying down. Now, of course, we're going to get a discount because we're paying within 10 days. Right? See up here? 2% if paid within 10 days. So I'm going to go ahead and compute the discount. Okay? So I'm going to take a discount on that balance, right? On the, not using the 3,200. I'm going to, because I no longer owe 3,200, I'm going to take a discount on 2,350. So if I got a 2% discount, it would be 2% times 2,350, and whatever that is, we'll go, and it's nice in Excel, you can just reference and, okay, so we're going to get a $47 discount. That's the discount amount. And that's going to be a purchase discount. Okay. You guys see all of that? Okay. I took 2% because that's what the terms are. Okay. So here we go. We're going to book it. Now, the whole accounts payable is going to go away. We're going to have a purchase discount credit 47. Okay. And then the amount of cash we have to pay is just the difference.
Wait, so how did you get that 47?
2% times 2,350.
What if you're doing 1%?
Or 1%? Then you just take 1% times 2,350. But those aren't the terms, right?
Wait, where did you get the term?
I got the terms from the original entry,
From the top one? Yes.
the November 2nd sale. You see right there?
Yeah. Sorry, mine's 1%.
Oh yeah, yours is, oh, you want to know what 1%? You want me to do the calculation?
Yeah.
Okay. I'll do your calculation.
See
Okay.
how it's right.
Well, we got to go over this again because we're getting that same question about this. So I'm going to do this one more time. Okay. These are the way the terms are stated. Okay, Mateo? So,
Right.
in this case, the November 2nd sale, it was 2% in 10 days. Right? In this situation, it's 1% in 15 days. Okay, so you could have any It could be substituted with any number in there, okay? So that's where I got the 2%. I got it up here on the November 2nd purchase. 2 and 10 total by the end of the month. Okay. Now, Angela wants the calculation for 1%, but you might have a different balance as well.
Yeah, I do.
What is your balance?
3300.
Okay, so let's not confuse this with what we're doing. I'm going to move that out of the way. You have 1% and you have 3,300. Accounting for the return as well, right?
Yeah.
You subtracted the return from the original sale?
Yes.
Okay. So all you have to do is take 1% times 3,300. Now, you've taken math. So right, you know in math that if you want to do something in a decimal format, you got to go move that decimal 2 spaces to the left to get right, from percentage to decimal, you go 2 spaces to the left. That's what I'm doing. Instead of writing out the whole percentage sign. So in Excel, and I think you guys kind of want to know what's going on in Excel. That's probably what you're asking. So to calculate something in Excel, and that's great. I try to add these things in. You hit the equal sign, and then you put in what you want to calculate. So I'm going 0.01. What was your number? 3,300, right? So the asterisk means multiply, and 3300, and then I just hit enter, and it puts it in there. Okay. Now when I did mine, since I already had numbers in there, I did it differently. I didn't retype the numbers. If you look at what I did in my calculation, I just referenced that number sitting there. So if you can see up here in the formula bar, that's a D6, right? Oops. So what it's saying up in this formula bar is it's saying take whatever's in cell D. You remember Battleship? You guys ever played Battleship? Yeah, and then it's like a grid, right? So the same thing, right? Except I took the grid lines out so it would look cleaner. But if you go to D6, right? D6, whatever is in D6, right? So up here in my, in my formula bar for that 47, I'm saying take whatever is in D6 and multiply it by 2%. That's what I did. Okay. Versus typing it all out. Okay. Since I already had the number.
So the days doesn't add up to those numbers.
The days do not add up to those numbers.
Like you don't calculate it with this equation. Because it's like 210.
The days are just it's like a stipulation.
Oh, okay.
So it's like an agreement. If you pay within the 10 days, then
You get 2%.
it's 2%.
Okay.
So that's kind of back to this thing here.
Sorry, I came in.
Right? So this is the way you read it. Okay, the discount and the number of days that you have to pay within to get the discount. And then that means the total is due in 45 days. So that's the piece that you're asking about. Okay. Okay, where were we? I'm here.
You gotta record cash.
Okay, so we're going to pay cash. So it's just understood. You don't have to call up and say, hey, I'm going to take the discount. Because it's already written on the invoice. All you have to do is submit the amount net of the discount. Right? So did you figure that out? That's going to be what? 2303? Is that right?
Sure.
10?
Yes.
Exactly, right? And that's cash.
And
You-
you subtract.
Yeah. So notice in this entry, the full accounts payable is going away. Right? The accounts payable that we determined, where do we do that? Right? The full accounts payable, I'll make this like this. 2,350, see here in yellow, that's going away. It's being debited. So we no longer owe 2,350, right? But we only had to pay 2,303 to get rid of it because we paid within the discount time frame. So we're gonna charge it to the purchase discount, which is gonna be an account that's contra to the purchases account when we run our cost of goods sold schedule. Let's see how we did. Okay. All right. Now, let's. We received cash on November 10th from the customer in full settlement of their debt, less the discount. Okay. So notice we've already recorded it net of the discount. Okay. So now we're going to get the cash. We're going to get 6,633, and the accounts receivable is going to go away. Right? We didn't have a chance to record a sales discount though in this particular situation, which I don't like. Okay. Did anybody try this problem? What did you get on this last? How did you record your last entry?
Regular.
Just like that? Yeah. See, the problem with this is when you do it in the net method, you're not showing your sales discount, which is a contra revenue account. Let's see. Okay.
Yeah, I would have showed the discount.
Yeah. I kind of feel like it shorts you a little bit on your full understanding of this thing.
The next one.
I will. Let me save this. You got any questions on this?
No.
Does anybody have any questions on this? Okay. You know what I skipped on doing here is I skipped on doing what I want to go back and do real quick is show you some of the periodic comparisons, right? So when did we do this? We got to the freight part, so that's the 140. Now, yeah, we won't do that. We'll save that for the next big problem, because I'm sure we got a perpetual problem coming up.
Yes, I don't know.
Okay, so the perpetual is going to be different.